When you talk about real estate as a pure investment, to me, the data is pretty compelling that it's not anywhere near as enticing or exciting as people want it to be.
All the stuff you find about getting, rich in real estate and investing your way into financial freedom through real estate, all that stuff's old. It's too old.
If you're buying a home because you think it's your ticket to wealth, but you're going to be house broke over it might not be worth it.
Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Talix podcast. We're here today to talk about whether or not they're going to build houses in space.
Yeah. Maybe for robots.
Yeah. Totally kidding. Look, we're recording this. The SpaceX IPO just happened. I am joined in the studio today by Rob McFarland. He is a realtor here in Southern Utah. Good friend of mine, and all around a good resource I utilize in trying to understand the real estate market that we're in here locally. Now, as we hop into this conversation, like quick reminder, real estate is really quite idiosyncratic, but there's consistency somewhat across markets because of the macro component, right? So just like if you start talking about the stock market, any one particular stock could be doing good or bad. Hey, any particular market or house or subdivision or development could be, well or not well, right?
Yeah.
So if we talk about St. George today, it's kind of like talking about maybe just a subsector of the stock market, right? So it's not a perfect comparison to any market that any listener might be in. But there's going to be some relative comparison, right? There's probably something to glean for most markets. And then you just have to decipher and distill down that last kind of final leg into like your market, wherever you're at, right? So that's all to say that, hey, Rob, we don't expect you to be expert or, deeply knowledgeable of every, different market in the U.S. for real estate, right? I mean, there's 50 states, multiple large metros in each one, plus all the suburbs and rural areas.
Yeah, I mean, real estate massive. Even locally is down to the neighborhood, just like you were saying.
Yeah.
So it is a lot like the stock market in that way. Is like you could talk about one subset, commodities, and then each individual commodity is going to impact differently into that same market, right?
Yeah. I mean, commodities and the stock market, it's two different things, but
right. That's what I'm saying though, is like the stock market, you have commodities, you have derivatives, you have all these other different, subsets of investing profiles. In a neighborhood, you have, short-term rental neighborhoods, you have retiree neighborhoods, you have first-time home buyer neighborhoods.
Well, there's Stanley Druckenmiller. He's a pretty famous investor, and he's got a quote, look, like when you make an investment, 50% of the return on that investment is going to be the macro environment, right? 30% of it is going to be the industry group, and 20% is going to be the alpha, potential alpha generated from like picking the best stock, right? So what it means is like, what he says is like, look, if you buy airline stocks, you're making a huge bet on the price of oil, right? There's a big embedded price or bet on the price of oil if you're buying airline stocks. So 50% of the return is going to be based on the oil driver, right? And then 30% of the return is going to be attributable to just like whether or not airline stocks as a whole did well, right? And then 20% is going to be whether you bought, Southwest or United or right.
How would that translate to real estate? How could you like?
So in real estate, like, listen, if interest rates go on mortgages to 10%, I don't care how great you think your market is.
Right.
Right. Like you're taking it. The macro bet is that like the economy stays good, generally speaking, right? That interest rates stay stable. Now it could be up or down slightly, but like stability is going to be probably most beneficial. Your industry group, right, is going to be more like something like, hey, are you getting into storage right now, or are you dealing with residential or new development or land? Are you dealing with single family homes? Are you dealing with convertible properties, right, where you're buying a property and turning it into a duplex, right? Like so all of those things are different. So industry group would be like that.
So like commercial, industrial, residential.
Mm-hmm.
Okay.
Yep. And then the last 20% is like, house A or house B, right? That's, like, hey, I can buy, this property on this side of town and it's got these types of, aspects
Features.
or attributes or features. And this is what I think the rent potential is and the growth potential is over time. Or I can buy a house on the other side of town or a different neighborhood over or whatever. And the deal's are slightly different, right?
Yeah.
And picking between that final stage. And so I think like the conversation that I really want to have when I'm thinking through this stuff is like, I would rather engage with, a local realtor in whatever market you're dealing with, or real estate agent, to find that last 20%, right?
Yeah.
Like, hey, building on this side of town or that side of town, right? And you're looking for them. That's where that local expertise is always going to, in my opinion, really, or local professionalism rather, I think is what I should say. And that depth of knowledge in the local market, that's where that's going to come into play. But first, what you have to do before you get to that is like, what industry group, right? So residential or commercial or whatever you want to get into. And prior to that is like, what's the interest rate environment? What's the general macro on this whole thing? Why am I even getting into the asset class as a whole? So, I will now take this back to, look, the question I always still get or see a lot is, hey, like, should I buy a house?
Yeah.
Rob, you're a realtor. To a guy with a hammer, everything looks like a nail.
Yeah.
But give us the real deal. What are you thinking? How's the housing market looking for somebody looking to buy a home?
I actually sat down with a first-time home buyer just last week, specifically with this question is the key discovery question he had in mind. He was sending me, a couple options that he was seeing on Zillow. He's like, hey, I didn't even think I could buy something under 300,000. What do you think of these options? So let's sit down and chat. And so when he came in, that was the main question I wanted to flush out was, should he even buy a house right now or not? Right. He's living in a rental. It's $1,300 a month, fairly inexpensive for just him and his wife, no kids. It's a little bit further out of town than what he wants to be, but it's a good value and it's stable. Like he's not worried about the landlord, bumping his rent and deciding not to, selling the place, things like that. Right. And so the main question I asked him, I said, where do you see yourself being in the next 3 to 5 years? Do you see yourself in Southern Utah, or do you see yourself potentially having opportunities elsewhere? Like, are you mobile, or do you feel like, hey, this is where I'm going to plant my family and go? And that was a question he hadn't really considered. And it was something that another client of mine who's going to sell her place is, she didn't consider that back in 2024 when she bought. She immediately met somebody. She 6 months later got married, and then they moved. They moved up to Wyoming, and she's kept the place that she owned as a rental, but it's costing her $700 a month.
Yeah.
To supplement.
Yeah.
Because the rental cost doesn't match what the mortgage is, and now they're at a point where they're going to have a baby, and that now they want to sell it, and we're 2 years later, and we're hoping they don't have to sign a check and pay money to be able to sell that to the next buyer based on the market value, right?
Yeah.
And so 2 years later, right? Almost 2 years to the month, right? And so thinking through that scenario for that first time home buyer, I think is really important, because if you look at mortgage interest rates, like you said, is there stability there? Can you afford a payment? What's the alternative to rent? In a lot of situations for that first-time home buyer, if they don't have a big chunk down to where they can lower their monthly payment or start eating up the principal payment to where you put it on a spreadsheet, they're paying rent less than what the principal, less than what the interest cost would be on the mortgage. They're actually giving more to the bank than they would the landlord, and not really building any equity, except for within that first 5 years, they're barely building up any equity. And so, could you set aside that money, invest it into something else a little bit differently? Can you save up some money to be able to, when you are in a position to buy something, the payment makes sense, and you're not putting your money away into an investment that ultimately you're not going to stay in, right? So that's the first time home buyer. I mean, that's the first thought I have for them.
I think if I just can I like try to add some numbers to what you just said and just make sure I'm following you right. So essentially what you're saying is like, hey, the rental market has actually become so disconnected from the buying market, right?
Here in Washington County,
to own a home,
for sure.
Right, every market's a little different. I think nationally, a lot
in
of the
Utah
macro
for
data,
sure.
Yeah, I think a lot of markets are going to be in the similar dynamic. Not every single one of them, but a lot of them, this is going to probably at least resonate with the surface.
Yeah.
Like it's just, and that's to say, look, it's a lot cheaper to rent the house than it is to buy the same house, right?
Yeah.
But what you're saying is, hey, if it costs you $3,000 a month to buy the house and a mortgage payment, right?
Mm-hmm.
And you look at that principal interest payment on a monthly basis,
Yep.
and 2,400 of it is going to interest, and you can rent the place for 1,800. Like where in the past, everyone said, hey, rent is just throwing your money out. Rent is throwing your money away. Rent's throwing your money away. It's like, well, like you're paying the bank more in interest than you would in just paying the landlord, right? So just pay the landlord, save yourself the $600 in interest.
Yeah, if you can make that payment anyway, then that money's just going into your pocket.
Correct. Right.
And you're not paying taxes and insurance and repair and maintenance and some of these other things that come up.
I'd argue you pay those as like indirect costs always anyways, right? To a certain extent, those costs are generally going to be passed through.
Well, what I'm saying is that when you put it on the calculator, though, you're looking at the mortgage and the interest. A lot of times you're not looking at, oh, there's this HOA fee, oh, there's this fee, oh, there's this fee. And so when you're just looking at it as the principal and interest, that's one portion.
Yeah.
And that might not line up. But did you factor in all these extra costs on top of it?
Right.
And when you factor all those in, you're right. You're paying that
true
alternatively
versus,
for the rent. True payment.
Like how much is actually going to paying down your equity, and is it enough that it actually, are you actually paying something down, or are you just like paying for the opportunity to say you're paying something down?
Right. Exactly.
No, it's like a really interesting point. What's the movement of the market generally speaking? I mean, like I just keep, hearing people say, oh, like, and listen, I actually have a lot of the conversations from the angle of like, I have to do something to help my kids get into a home, because if I don't do something here, they'll never be able to get into a home. Right. Like as if the market is running away from them.
Yeah. I would say that the market's not necessarily running away from them. I'll take a step back too. And I think we're in this weird moment of time. This is in Washington County, and this is generally true of Utah. And so I'd be curious what other states, so I think jumping in the comments and saying, hey, this is kind of similar to what's happening in my state, is that when we started approaching, max alpha in home value appreciation, right? Back late 2021 into 2022. So like basically a 12-month period from 21 to 22, home values just was a rocket ship. At that same time, as interest rates started going up, the interest rates went up so quickly. At the same time, there was a bunch of new investment into rentals because the conversation around affordability and providing smaller investment properties and rental options, right? Just housing starts. There was this big push from 2018 really into 2020. There was a big push for developers and everybody to build more rentable places. And when that boom happened, a lot of people picked up a lot of those rentals. So we had this huge supply increase in rental options, whether it was apartment complexes, but also duplexes and smaller type properties or rentals could go up. So we had this huge bump in rental supply, and then interest rates went up. And so you had this crossover where rents actually went down while mortgage rates went up significantly. And so now with rates not really changing all that much since about 20, I mean, it's gone up and down, up to 7 and down to 5.99. I think is probably one of the lowest spots it's been over the last few years. But rents have only now just started to come back up. So from 25 to 26 and 2025 to 2026 in Utah, it was the first year in the previous 3 years where rents actually started to go back up. They went down every single year from 22 on to 25. And so that's that weird moment of time where those two things don't normally happen at the exact same time, where the cost of living in a house and the mortgages go up so fast and rents actually came down. So there's weird intersection. So as an investment, we think, oh, well, it is cheaper to rent, and it's for a small period of time because eventually rents will catch up, right? We all know that rents eventually come up. Yeah, I think so. I think they will. I mean, they've already started to recover. Rents have already started to come up, and if landlords have extra overarching costs, whether it's insurance, whether it's taxes, whether it's the property values in general, they're going to want to recoup some of that delta.
I think what I'm going to say is like, yes, they want to, and if the market is strong, they can. The problem is like, do they have the pricing power? And the reality is on a macro level. So when we go back to the macro level, affordability has become so stretched. Real wage growth is actually contracted post-COVID. So people en masse are actually earning less money than they did before COVID. On a nominal level, they might make more, but on a real basis adjusted for inflation, it's actually less. And indexed to housing, it's actually significantly less. So affordability is like really, really stretched. And what you can't do is you can't just say, well, you know what, I had to fix this house, or my taxes went up, or my insurance went up, or the price of the value of my home went up. So like your rent's going up. Like you can do it for a certain period. And if people are having real wage growth, then like you can potentially pass some of that on. Certainly if they're having nominal wage growth, you can pass some of that on, but there's a limit to how much they can, because at a certain point, people just say like, look, I was renting because I couldn't buy. Now I just can't rent. Right. Like, and you and I both know that people don't just say, well, you know, rent's just gone up, I guess I just won't eat. Right. Like it's a necessity, but it's actually one of the easier necessities to try to combine with another family or, you know, group of families as a resource. Right. So if you look outside the US, a lot of, multi-generational families, you know, live in the same house. Mm-hmm. Right. I think that's like culturally, more normal outside the US. It's just, you know, that's,
so you're saying that you don't necessarily think that rents are going to continue to climb. You think that there's a ceiling?
I think that there's a significant headwind. I think on a real basis, there's definitely a significant headwind, right? Mm-hmm. On a nominal basis, maybe they start to climb slightly, but I only think that comes if there's high nominal growth and there's significant, you know, wage growth too.
Do you think that gap though between owning and renting is going to shrink over the next 5 years, or do you think it's going to stay the same, widen? What do you think that's going to happen? What would be your anticipation for that?
I don't know that I don't really feel like I have a crystal ball on this. So I don't want to get out over my skis on making a definitive prediction, so to speak.
I think that in general, what I'm saying, just to that point, it's hard to predict. It's hard to predict. But if we look at home values decreased about 17%, this is Washington County, decreased about 17% from the peak in April 2022 until about today. Mm-hmm. So they had pulled back about 17% from the peak. Yeah. But now we're starting to see it climb at a 3% rate based off the last 2 years of data, right? It's like we've been up about 2 to 3% on the average price sale over the last 2 years. It is still climbing the average price point. The median has stayed roughly the same. I think right now we're over year, we're up.
But you and I both know that the average price is you know, if you go look down, like in our community here, if you go look down by like Crimson Cliffs High School, man, there's
the average price year over year is up 11%. Right. Yeah. But the median is only up 3.8. And so I like to look at the median, but even at 3.8, as the median price sale continues to climb and has started continuing to climb after the initial pullback, is that if home values are increasing, it seems to me that it would be likely that rent values are going to continue to climb as well.
But you have to ask yourself, is that on, like, what really matters is a real basis, not a nominal basis. So if home values are climbing at 3.8% and inflation's climbing at 4%, your home didn't go up in value at all. In fact, your home went down in value because it's a depreciating asset. So the value of your structure became less and less attractive.
Yeah,
right?
Fair enough.
And the rentability of that, right? Like what commands a higher rent, a brand new house or a house built in the 70s?
Yeah.
Right. Like,
right.
Obviously, you know, extremes for illustration, but, if year over year, like if your home is depreciating in value as a structure and it's just going up with, you know, it's going up, but trailing inflation. I guess what I'm saying is like, yeah, rent could go up slightly, but is rent going to go up higher? Like, is it going to go faster than inflation? And that's what would cause a real squeeze, mm-hmm. right? That's what would close the gap. I think the more that rents go up less than inflation naturally causes that gap of rent to own to close somewhat mm-hmm. naturally over mm-hmm. time.
Right. So I guess going back to your question is, I got to do something as a parent to be able to help my kid get into a home because they won't be able to because it's running away. I think the general conversation is, I don't think it's running away. I don't think we've seen with this median price values increasing here in Washington County. I don't think it's running away at this point. It seems to be moving at the pace of where wages are going and where affordability maxes out, right? Which is the interest rates that we have, the average wages, and the median value of the home, right? So that affordability index, that seems to be where the market is climbing at that same rate. And so it's time on task over time, right? If you're wanting to help your kid get into a home, it's getting them into a position where they have a steady job, where their wages are affordable. And then are they going to stay there for a meaningful amount of time? Because if it's, I'm just going to get into the home to say I have a home for 2 years, it needs to be looked at from a long-term perspective. It's a long hold perspective. Unlike basically from 2018 to 2021, it was this mad scramble because of the way interest rates were.
Yeah, you said something interesting there. Like it has to be a long-term hold perspective.
Yeah.
One of the things I'll remind listeners really quick is, it's always easy to have that quip or that notion in like at the entry point, right? It's always excited to be easy. Hey, I'm a 30-year investor. Hey, I'll live in this home for 30 years. A couple of things. You have to remember life happens in the meantime, right? So like life circumstances change, job changes, family circumstances change. The next component is like, hey, if you're parking your capital in real estate, it's actually a very unproductive use of capital without the use of leverage, right? So like we just talked about the price of a home going up 3.8%. So I think that's
the median,
generous, right? And, around here, if you get a 3% cap rate on a residential deal, it's like incredible. Yeah. So you're talking a 6.8% nominal return. That's like not exactly a great return, right? There's,
there's other options.
For perspective, you can buy mortgage bonds that pay 6. Mortgage bonds currently yield about 6.5. Okay. Anyway, so there's like it. Obviously, it depends what your mandates are, why you buy something, but you have to then use the leverage if you want to get this like effect of like, hey, building the home is going to build wealth for me or my kids, or like it's going to run away from us if we don't do this. Like you have to use the leverage, and now what that means is like you have a cost of carry. Okay, that's quite significant, right? With real estate, obviously, you always have some kind of cost of carry because of insurance and taxes and maintenance. But you put that mortgage payment on, you have a debt obligation, right? If something happens in the meantime, right, that you can't meet the obligation of the mortgage. And it's one of those things. Real estate becomes all of a sudden it's everything or nothing, right? And so if you say, hey, I'm going to be, I'm going to hold it for the long term, you have to make sure that you factor your entire financial life around the ability to actually hold it for the long term.
Yeah, for sure.
Right.
Yeah, I would agree with that 100%. And really, there's the easy thing to say. It's a 30. I'm in this at a 30-year clip, but what your return is, if you're looking at it as an investment versus I'm looking at it as a place to where I can build roots and I can grow a family and I want to get into the community and the neighborhood and all of those things that come along with that lifestyle choice.
Yep.
Those are two different perspectives, right?
And I think that's worth touching on, right? So maybe expand more on that and what you think like the intangibles are, because I think there is, when you talk about real estate as a pure investment, to me, the data is pretty compelling that it's not anywhere near as enticing or exciting as people want it to be. Recency bias tells us it's very exciting, right? But investment returns aren't built upon what has happened the last 15 or 18 years, right?
Right.
It's based upon what happens the next 15 or 18 years.
Right.
And so I think from a pure investment perspective, there's a number of headwinds to real estate, especially in the residential space, right?
Yeah.
But there's other reasons to buy a home. So hit us with it. Like, what's your?
Yeah, I mean, I think if you're going to want to, if your idea of the American dream, right? Or if you're thinking about starting a family, or you're thinking about I'm a move up buyer, like for my wife and I, for an example. We bought 2 investment properties, one in 2020, one in 2016. The intention was to live in it for a few years and then turn it into a rental and have cash flow, because the math made sense in both those 2 windows. And so at this point, we're actually stuck in that second investment property because we watched interest rates go up and home values had gone up so high to where the trade-off for me wasn't, I could turn that into a rental, but now my mortgage cost is 3-4 times more than what I'm paying right now. And do I really want to trade off the lifestyle that I have right now for a house that looks a specific way, that's in a specific neighborhood. And so the conversation my wife and I are always kicking around is, we have low maintenance, we have a low mortgage payment, we have, everything is inexpensive for us in this investment phase. I could rent it out and immediately cash flow after all those expenses are done. And what's the alternative? If I go and am house poor and now I spend all my time at the house, right? We get a house with a yard, and now I can't afford the landscaper. So I'm going to do the landscaping on the weekends, and we can't go do this thing. And we can't travel, and we can't do these things. Right. And so it's the trade-off of the lifestyle for that move up buyer. And what is that trade-off? Can I expect to make more money later on to where now I'm not house poor and we can continue to go back to those things because I invested today, where home values, if they are continuing to climb, is it just going to be more expensive for me to buy a year from now than it is today? Right. Nobody has that crystal ball, but we're gambling on that trade-off. Right. And so, in those scenarios, first time home buyer and for that move up buyer, the function of your lifestyle and what you're choosing is important. It's something, there's some calculus in that I think everybody should, consider. And so investing in a community, having a neighborhood, being close to schools, I think about this all the time, is like, if I lived down the street growing up, I could walk to school, right? Jeff Watkins, business partner of mine, Jeff, he grew up like half a block away from his school, and he loved it. He was always, he never was in the car, right? He was always riding his bike to school or riding to and from practice and all these other things. And so the lifestyle for him as a kid was similar to mine, where my kids now, we're about 2 miles from the school, right? And they're little. And so is it a little bit more labor intensive? Does it take me 30 minutes to get over to Walmart and to go shopping? And it's gonna have all those functions into it. And so that's the trade-off. And location seems to be the number one driver of values in Washington County. Washington City has just overtaken St. George City as the highest average price point. A lot of it is because of some of the McMansions out in the fields, and these million.
Well, a lot of those are out in St. George, actually.
Yeah, the vast majority of them we've seen from the data is in Washington, in the Washington City limits, right? And it goes all over the Washington City side. It's not just in one area, right? Sure. But Washington Fields in particular has a lot of really big houses, 6,000 to 10,000 square foot homes on 1 to 1.5 acre lots, half-acre lots, right? These massive homes, and they're selling, and they're continuing to sell. So the average price point went up there, but it's because of the location. Location seems to be the biggest driver. First, the school ratings for the Crimson School District outpace the other school districts. The shopping and the development opportunities that are out there on the commercial side have been long time coming, but now coming to fruition. And so there's a lot of value that buyers are putting into those areas. And so the lifestyle of your neighborhood seems to be the biggest driver of where home values are at, right? And so if I, want to be on the outskirts of town, that's a different lifestyle than if I'm in the thick of, suburbia hell, as I call it, right? Some people really want that, right? It's,
Sure.
there's some value in that, right? And having kids in the neighborhood, do I not want kids in the neighborhood? All those things come into play on what are the values of the house outside of, if I'm in a rental, what area of town am I in, right? The fields, there's not rentals out there. I mean, there's a few, but you're going to be paying even more of a premium to be in a single family house than if you were in a townhome, in Long Valley or out in the outskirts, Santa Clara or somewhere else. Your lifestyle is going to be different when you're renting in these different socioeconomical areas. And it's just it's the byproduct of the way cities develop and the way development happens.
Sure. I think all of that to say, if you have stability in your life, you're ready, willing, and able to buy a home. It's not you're not stretched, right? Like, you're saying, hey, the trade-off might not be worth it because we'd be so stretched compared to, so i.e. just like, hey, we could move, we'd be house broke, right? I don't want to be house broke.
Right.
Okay. So if you're buying a home because you think it's your ticket to wealth, but you're going to be house broke over it, might not be worth it. If you can comfortably afford the mortgage on a home that meets your needs, right? And you have that stability in your life, right? Your income is stable, your career is stable, you're going to continue to live in St. George, right? Or whatever market you buy in, right? That's all stable. Your, personal family planning is somewhat like stable. If you're in the thick of your 3 kids deep and you're planning to have 12, like that's not maybe stable.
Right.
Like,
yeah, it's true.
But look, if all those things are stable, then, like you can buy a home. And even if it's not the most official use of capital over the next 5 or 10 years, from a math perspective, sometimes the intangibles of having that stability in your life for your family can be valuable as well, right?
Yeah.
I think that's really what you're saying.
Yeah.
You have to make sure that what you're buying meets, your lifestyle, your goals, your, what you're looking for long term. And I think the overarching thing is don't go house broke over it, right? If you have to go house broke over buying a house, then like it's not a market that is going to run away from you. Spend an extra year or two getting your finances in order, adjusting your lifestyle appropriately. I almost think of sometimes there's like the old idea, like if you're wanting to buy a new car, right? So you have a paid off car and you're like, oh, I could buy and finance a new car, $600 a month, right? Just like, hey, make that $600 payment to yourself. Like start making it to yourself. See how that feels for, 6 months or a year. Worst case, you get to the end and you've got, $7,200 saved.
Yeah. And then that goes back to the conversation I had with that first time home buyer, is that him and his wife has saved up about $21,000 over just the last year.
Yeah.
And it's because of their rent, and they've already proven, and this is what I told them, I said, you've already proven that you can set the money aside instead of spending it. You can continue to make this payment, which he's comfortable with. He's like, well, I can make this payment on, a mortgage payment, and I'm comfortable there. Because he's already paying himself that, right? He's already stacking up a savings account at a pretty good clip. So he's already proven that he can do it. And that's where the conversation ended, is that, you're in a good position to where you could buy if you see yourself here over the long term. However, if you decide to sell in 2 years, what all of that work that you put into it is going to go towards commissions and costs and fees. And now you're not going to pull any money back out of it at the end of it, right? And so, if don't make a great investment option and turn it around and make a mistake by, showing that you can save money and build up that equity if you don't really plan on having this as an asset for long term, And if it means continuing to save up money to where you can get that payment down to where if you do want to rent it, it can cash flow or cover itself, then that might be a great strategy if you're not sure you're going to stay there over that long term. But that math, it's a big down payment nowadays. I
think if you wanted to make it really simple for yourself, right? Like it's simply asking yourself the question of like, hey, forget about what homes are going to be worth in the future or what the price appreciation on homes is, hey, someday I want to own a unit of shelter, right? I want to own a unit of housing, simply so I can control my costs and so that I can own it, right? I want to have that controllability, predictability, stability in my life at some point, right? So what's the price of a home today? What's the price of that mortgage? What's the price over time? And can I just stay in it and just make the payment every single month? 360 payments, 30 years, pay it off, done. You own one unit of housing. At that point, you almost have to ask yourself, if that's our goal anyways, which a lot of people that are buying homes, it is, to what extent does it really matter if your home is worth, you buy a home for $500,000 a day, to what extent does it really matter that it's worth $500,000 in 30 years or $3 million in 30 years, right?
Right.
You just need a unit of housing.
Right.
What's the quickest way to get there, right?
Yeah.
A mortgage is going to generally be one of the quicker, easier, and safer ways to get there. Yeah. Right. But it's not about projecting out where housing is going to be the next 5 or 10 years. And that's why I say if things are really, truly super stable, you can project out further and say, what about 30 years? I just want to just buy it, pay the mortgage off. Right. I think where a lot of people go wrong and where I've seen a lot of people come into challenges as they try to come into their retirement planning is the refinances, right? Hey, they end up buying a boat or getting in credit card debt. So they do that cash out refinance, that debt consolidation refinance. Hey, the rates drop a ton and so they refinance, but they don't match their current amortization schedule.
That's right.
So they get to be in their 40s, they do a refinance and they restart a 30-year mortgage going like, look at how much cheaper my payment is.
Yeah.
Like, yeah, and the interest rate's great, but that money that they save becomes lifestyle expense, and they don't take it and, say, okay, well, we dropped our payment. Now we can invest more money, use market tailwinds or invest in other instruments that pay more than our cost of interest. And so let's build up a pile of cash so we can pay the mortgage off whenever we want.
Right.
Right. They just go, look at how much cheaper our payment is. Well, now your home's not going to be paid off till you're 70. Right.
Right.
It's deep in, that is into the years when people expect to be retired.
Right.
And so like the refinance is what catches a lot of people off guard. They just don't project out far enough the implications and navigate that correctly, because it's just enticing at a certain point. Hey, I felt housebroke for so long. Now I can refinance and look how much cheaper it's going to be.
Yeah.
Sometimes it's like actually more expensive, but they say, I've been paying all these credit card payments or boat payment or whatever, and I'm going to just refinance and look how much my payments go down. I save all this money every month, and that's how it gets pitched to them. But the reality is like, look how much money you're going to pay in interest over the years now, because you just took, a 10-year boat loan and just amortized it for 30 years. Your interest rate is 2 points lower, but your payment's lower because you're paying less principal. Like it's going to take you forever to pay it now.
Yeah. It's interesting because I think a lot of people, they don't actually do the math. They don't actually put it down on a spreadsheet and then look at it.
Yeah.
I had showed, my client that I met with, I showed him the amortization schedule of, an option that he felt comfortable with. And I showed him what that equity built out is over time and the amount of interest. And he had never even looked at that.
Yeah.
He had never even looked at that. And a lot of buyers don't even look at it until their loan disclosure, right? They're like at the finish line and, they have, 2 weeks before they're closing, and now they get this disclosure on the amortization schedule, and they, even if they're might change their mind at that point, it's too late.
Yeah.
There's too many things already built up to where you can't even turn around at that point.
Well, the problem, Rob, isn't like the interest you pay, right? Like there is a cost to borrow money.
Right. True.
There's nothing wrong with like when people are like, oh, that cost over 30 years is going to be as much as the home itself.
But the
like,
idea itself, right, is to like consider that.
Well, yes, it's like consider that. The problem is when you get too far out of whack, right? So if you're paying $1 million in interest over time for a $500,000 house, right? Like, does that still work? And the answer might still be yes. I don't really, what it comes down to is like, what do you think the $500,000 house is going to be at the end? Because if you buy a $500,000 house over 30 years, pay the $500,000 off and pay $1 million in interest, and it's worth $5 million at the end. Like it's absolutely worth it, right?
Yeah.
Like,
right.
So what's your long-term forward-looking projections? And then does that cost of interest at the final valuation of the home make it upside down or not? Right.
Right.
Very difficult to do because like 30 years is a little bit further beyond the horizon than I think people can accurately forecast.
Yeah.
So it's tough, but again, if your goal for me is like, if your goal is to just own a unit of housing, right? And this is what I explain to people, like, hey, if you own a unit of housing at the end, right? And then you say, well, I don't want to retire here. I want to retire somewhere else. And the market crashes. Like, yeah, but you just sell your unit of housing that likely went down somewhat similar to what the market went down. And you go and buy one more unit of housing wherever you want to land. There's probably going to be a similar cost, right? It might be plus or minus one, directionally slightly, but like, you own a unit of housing, it goes down, you buy another unit of housing that also had gone down, right?
Right.
And when it goes back up, it goes back up. So should the market go up a lot and you want to relocate, like, yep, you sell a unit of housing and you buy a unit of housing. Now there's transactional costs to that, right? And again, it's plus or minus, but broadly speaking, it's all the same. I think that's one of the reasons why in Washington County, and you've got the data, we've seen a lot of people like that come here and they're like cash buyers, right?
Yeah.
Like
I was actually just looking at that right now.
Regardless of the interest rate activity of what's going on, high, low, whatever, they own a property somewhere else that they're selling.
Yeah.
They're just selling a unit of housing and they're just coming here and just buying a unit of housing. The interest rate environment, the payment, all this nuance, like doesn't matter. They just want to own a unit of housing.
I'd be curious what the different markets are outside of Washington County, because it's tough to get this data. We get it because the MLS, we record what kind of loan they got when we close out. And not all MLSs do that, and it's not all public information, right? And so in Washington County, in just May, 30% of the home sales were cash. So 53% of them conventional, 11% FHA, 5% VA, one owner financing. This is for single family homes. And then Utah Housing, they had one. And so, which is like a FHA, first time home buyer loan program. And so 30%. And if you look back over the last 5 months of the year, it's about 26 to 27%. So for the first part of the year, it hovers between 25 and 30%. And so seeing that amount of cash, 30% cash coming into the market, I think it seems a little bit high for the majority. If you step out macro, it's probably not that high. I think we have a lot of cash buyers because the markets that feed Southern Utah are from markets where the home values are higher than where we're at. And so they can sell something they have there that's smaller and buy something bigger here or nicer or, whatever the case may be, if they're downsizing, whatever. They have the money to be able to come in and just buy it based off of what their appreciation was, and whether it's Washington or California or even up in Salt Lake in some areas. And so there's a big amount of cash in Washington County that eats up a lot of the market.
Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. I think the reminder on that too is, when there's not a lot of animal spirits in the market, it's a lot harder for a market to crash. So if homes truly are, being bought at 30% of the transactions are happening cash, that's probably a really good indication that, look, the market's probably not about to run away from you.
Yeah.
There's not just incessant bidding happening, right? Homes aren't flying off the shelf.
No.
But it's tough to force people out of a bunch of properties that they just don't know anything on, right?
Yeah. Well, it's interesting that to your point, this is happening in Washington County, and I assume it's happening in other markets as well, is the homes that are priced well right out of the gate are flying off the shelf. There's a big difference between homes that are getting 99 to 100% of their asking price with almost no negotiation in the first 7 to 10 days. And then there's a big discount that you're getting if you've been on the market for over 100 days. If you go over 100 days, you're getting between 92 and 95% of your original asking price.
Yeah.
And so that difference is, when you're priced well, buyers are paying what they see as value. And if it sits on the market, they recognize that the rest of the market has ignored it, whether it's priced well or not, and they're wanting a steep discount.
Yeah.
And so it is kind of a split market in a way, is that when it's priced well, it's moving very quickly, and when it's not priced well, it's getting hammered or just not selling at all. We're about only 75% of the homes and the listings hitting the market over the last 12 months are actually selling. They're either canceling or expiring off the market.
So 25% are canceling.
25%. Yeah, 25%, which is really similar to basically the 2020, 2014, 2015 is kind of the last time is around that amount. And then the market started to pick up again, out of the bottom trough of the housing market collapse, because our bottom here in Washington County was about 2011, 2012. And then it started going back up again. But the expiration, because they started seeing recovery, they were asking more in value than what was actually asking for, what the market was willing to pay, and they were expiring over and over again. And so, only about 75% of the homes are actually selling. And then of the ones that are selling, when they're on the market over 120 days, they're getting hammered on price. They're getting hammered.
Yeah, I was surprised to see, I know I recently did a home search, and I was really surprised to see how much was on the home, and like the days on market was way more than I had.
Yeah. Average days on market in May was 72 days. In April, it was 83. So we actually have increased the speed and the average days on market. And then in comparison to May of 2025, it was 76. So we've hovered right around that 70 to 80 days on market. Yeah. Cumulative days on market. So the total time that it sat on the MLS and ready to sell.
I think it's generally, is it, do you think I'm misguided if I think it's kind of just almost like a stale market? Like, it's not really exciting one way or the other. Like prices aren't dropping through the floor. But they're not climbing. There's not a big demand, but there's also not there's not a big demand to buy, but there's also not a massive demand to like sell, like where people are just like, hey, at any price, get me out of this home. I gotta sell.
Well, I mean, the demand, the interesting thing is you're right on demand. The listing inventory just crested up over 2,000 active homes on the market. It's 2,046 as of the end of May. So it was like beginning of June. And so it fluctuates every day, right? Some homes go off the market, not on the market. But it's the first time where at the beginning of the month, it registered over 2,000 active listings in Washington County. This is just Washington County. So I hold the data. You'll see a lot of different data sets out there. Utah Real Estate, Zillow, they'll have all these different ones, but this is direct MLS, direct numbers for the county only, because they'll list stuff in Iron County or up in Salt Lake on our MLS. So it's just our county. The first time it's happened since 2011. So April of 2011 was the last time we were over 2,000 homes on the market.
Yeah.
And so it's interesting to see that supply is at a really, really high level, like more so than I think most people actually realize.
It's pretty fair level. One of the things I would just like call out though, when I hear these stats, I always think like, okay, what's the nuance I'm missing? The nuance I think that's missing right here is like how many more homes are in, the county than in 2011, right? Like there's a lot more homes. And so on an adjusted basis, like if you said, what percentage of homes was that in the county in 2011 versus what percentage of homes is 2,000 homes in the county now? It's like a lot lower of a percentage. Does that make sense?
Yeah.
But
the idea that even though over that last, how many years is that, right? We're at 15 years.
Yep.
The first time it's gone over 2,000 in 15 years of building, where we've had multiple housing, construction booms. Like we just now, have met what the highs were of 2018 and 2019 of the amount of new construction. 2008, we were building more homes even then. So the thought though is that it still took 15 years of new construction for active supply to get over 2,000. I think it's meaningful in a certain sense.
It is meaningful, but I guess what I'm saying is like the ability for that number to go much higher is like, don't price that out. Like don't have a little bit of imagination here. Like just because we're like, hey, last time I got this high, that was like right near the peak of the bottom, right? Or not the peak of the bottom, the peak of the bottom.
No, the peak was over 3,000. Right. The peak was over 3,000 active listings on the market. Like 2008, 2009, it was over 3,000. So it was falling, but the last time we were over 2,000.
So I would expect 2011. Like we're accelerating into probably available inventory.
Well, so the way I look at that is the absorption rate. So how fast are homes going on the market and then coming off the market? So the measure of supply and demand, right? As an absorption rate. And so we're sitting right at 5.64 months of inventory. So it takes 5.6 months to deplete the 2,000 listings as on the current run rate. And that's basically stayed stable. We've been at roughly between high 4s and into 5 for the last 18 months. It continues to climb, but it's climbing very slowly. Right. It's climbing slowly.
Well, yeah. Real estate moves at the speed of a glacier.
Yeah, exactly. And so we were at 5.38 in May of 2025. Really, this is another interesting point of this is that the pending sales, so the amount of homes that went under contract are actually up 11%, where our closed volume is down 11%. So that means people are putting offers in on homes and then pulling out and canceling the deal and then not actually ending up buying anything.
Yeah.
And so it's interesting to see there's demand that wants to buy, but affordability and the reality of the homes and the quality of the homes, the prices that they're paying, they go under contract and then they change their mind for one reason or another, right? Yeah. There's a myriad of different reasons why they cancel, but it is really fascinating for me to look at pendings are going up where buyers are putting offers on multiple homes, right? They're putting an offer on a home, they cancel. Then they put an offer on another home, then they cancel. Then they finally end up buying one, right? So that's 3 pendings for one closed sale. So that there's demand out there, but getting to that closing finish line is demand's down 11% year over year.
True demand.
Yeah, true demand. So it's interesting to see demand being down low and active inventory being where it's at, is that gap's widening and that absorption rate is going to continue to drift, right? Yeah. Which is going to ultimately cause prices to continue to stay stable or start to drop. 5 months of inventory is basically a balanced market, right? Anything up to about 6 months of inventory is balanced. You get up over 6 months of inventory, and now you're going to see significant downward pressure on pricing.
Yeah. Well, I think it sort of sounds like it's the idea. Like if you ask everyone, hey, who wants a Porsche? Almost everyone's going to raise their hand, right?
Yeah.
You know what I mean? There's always going to be the weird guy that's like, no, I prefer,
A Ferrari,
a Corvette, or I prefer whatever, right? And that's the guy that like he doesn't want to own a home, he wants to own a lot up on the mountain and live in a tent, right?
Right.
Congratulations. Most people are going to raise their hand.
Mm-hmm.
Okay, but then the next question is like, okay, so who can qualify to buy one, right?
Yeah.
And a ton of the hands are going to go down, right? So like, who wants to buy a home? A lot of people want to own a home. Who's qualified and can buy one? A lot of the hands go down. Okay. Then the next question is like, okay, who's ready to actually sign on the line
right
today?
now?
You know what I mean? Who's ready to actually transact? Because we have them here ready for delivery. And, a ton of the hands go down because a lot of the people that can are just looking at the environment going, it doesn't seem like I'm in a big need to really do that. And so I'm going to evaluate my trade-offs more than I maybe would have a couple of years ago when there was, panic buying going on.
Yeah.
Right. And I think it's fair. I think I've always said, people talk about a shortage of housing, right? Based on a number of families. And I say, well, it's like the Porsche conversation, right? Because the only thing that matters is, maybe the number of people that are capable of buying, but really it's the people that are, ready, willing, and able that are, here to sign, right? They're ready to take delivery of that car. If they're not serious about that in the market, then like, it doesn't matter that you measure them as somebody with a driver's license. It's not really actually demand.
Right. Exactly.
So I think it's an interesting stat that you call out because you're highlighting that like, hey, there's a lot of activity maybe, but if you look at the wrong data point, it gives you a very false picture, right?
Exactly.
It gives you a picture that there's a lot of demand for housing, and man, as soon as rates come down, the bidding wars are going to start. Or whatever the FOMO talking point going out right now is, right? And the reality is like, no, it's actually like, hey, if you put your home on the market and you're not ready to really sell it, you're going to get eaten alive by people giving you offers and then getting under contract and jerking you around and, nickel and diming you over every little repair thing and concessions. And they're going to beat you up over it because they basically know they can.
Yeah. It's the exact opposite environment of 2021 where the sellers were making out with multiple offers and $10,000, $15,000, $20,000 over asking and no concessions and, hard earnest money, all these crazy things. And now the roles have reversed and buyers they see the writing on the wall and they see the market, environment, and it's a lot more difficult for sellers to get it done, which is why it's so important that pricing is the key piece. If you are ready, willing, and able to sell, is being competitive on pricing is going to be the best way you can get the most money out of the environment today because of the competition and because of the shrewdness, so to speak, of the buyer, is that you have to present the product that you have in the best light possible, the absolute best light.
Yeah.
Especially with 25% aren't even selling. They're just expiring.
Well, I think those are the people that they're not actually ready to sell, I think.
Yeah. Or they're getting bad advice. They could be getting bad advice from their agents or the internet in general. They think something is where there's value and there's actually not value.
I see that a lot in like the price drops, like the eventual price drop. And, I think there's a disillusion where a lot of people bought in 21, 22, maybe even 23 with this notion that like real estate doesn't go down. You can't lose money in real estate. Like it's housing. Housing goes up every year, it's like and I feel like I'm when I look, or I'm talking to people, the spot where I find there to be the largest disconnect is the people that bought in those years and they really probably are underwater on their home. Especially net of like transactional costs. And they don't want to believe yet that they're going to have to sell their home and take a loss, right? Because who loses money in real estate, right? Real estate just goes up. Everyone, gets rich from real estate. And it's like, no one ever talks about the losses, but they do happen and they're usually quite significant. And Just what comes the nature of leveraging your equity, right?
That's right.
That's what happens. But that's a demographic that I see struggle with that, right? And you generally see it in like just watch next time, right? When you're like, this house seems a little overpriced.
Mm-hmm.
What gives? And you go to price history on the MLS, and then it's like, oh, it's like they listed it at the same price they bought it at in 22.
Mm-hmm.
And you've talked to enough people trying to sell homes over time that every single time that happens, it's because they have what's called an anchoring bias,
Mm-hmm.
right? Like they have to get that number for it. Well, how come? Because that's what I paid for it. I'm not going to take a loss on this.
Right.
I've never lost money on real estate before. I'm not going to do it now. It's like, you don't get to make that choice.
Yeah, exactly.
Right. Like that's not how the market works. So you end up getting stuck with the house.
I've never lost money on real estate, and I've only bought 2 houses in my entire life. And it just happened to be in 1990 and 2000,
15
one
or something. Yeah.
Yeah. Like just like the stable markets where they were followed by massive booms, and then they sold it right as, things started heating up and they made money, and then they bought something a little bit lower and then it boomed again,
Yeah.
There's a lot of people that are like that they never lost money on real estate because they just happened to hit the market waves at the right times. Because why do people buy and sell a home not as an investment, but as their own primary residence? Because life changes. And a lot of times you just hit the cycle right and you make money. And a lot of people hit the cycle wrong and they lose money every time, Yeah.
And I have no shortage of people that have said every time I've ever bought real estate, I lose money somehow.
Yeah. Yeah. It's true. But it's not, it wasn't up to them.
But I've met as many people on the other end of the spectrum and say, I've never done anything but just made money in real estate. This is like the safest thing I could ever do with my money, right?
Right. And it wasn't anything that they chose or decided on, that they just happened to, I'm such a wizard with real estate that I made this money. It happens to do with the life changes. Yeah. I got married. I bought a house. I got a raise. I bought another house and I had kids. And then we retired and sold the house, right? And just happened to be in the markets when they were doing well.
Be interesting to do a study on what element of like trend following is apparent in the real estate market.
For what? Like trend of what?
Just like it. Well, real estate trades so different than everything else because it's just illiquid. And so it moves at a super slow pace. So people kind of say like, you can't time the market, but like, I guess what I'm saying is like, I wonder if there's a natural element of trend following for a lot of people where like, if you say like, hey, like, I bought a house in the 2000s and then like, 2007 lost my job. So we moved. Right. And like, that was a natural occurrence, right? Of like, hey, I got laid off, and it was because we were going into a massive recession, but wherever they moved, so they sold their house to move to the new job they found across the country. And there they just said, we're going to rent for a minute while we get used to the area. And then the whole thing falls apart. Right. And so they actually kind of like were naturally forced into a trend following potentially is kind of my thought. Right. And then, and then, hey, oh man, we've been here and stable. Like, man, look how cheap the prices are and life's stable again. I'll just buy. Well, like now you just bought the bottom and you're just like, to what extent do you then be like, what I'm going to do is like, man, we've been here and this is so awesome. We rode this property values up, and, now with this COVID thing, we just don't really love the area anymore. We're going to move somewhere else. And so they like naturally just sell, that's like a natural time to like sell their house and move somewhere else. Right. And like, to what extent do people just kind of, be like, hey, COVID happened, 21, can't take it anymore. We're moving somewhere else, and they just rent somewhere. Now they're just like, I'm comfortable renting. I don't know. I would just be interesting if like I could study that somehow. The data would be almost impossible.
Yeah, it'd be tough.
But that's just what it was like. As you were talking through that, I'm like, I wonder to what extent. And then the opposite happened, right? Just like somebody's like, hey, we bought in, 2005, everything seemed great and stable. And then they're like 2010, I got completely laid off. I was the last guy laid off and couldn't keep it anymore. And so they get forced out of the bottom, right? Yeah. And then like, they're like, I'm not doing that again.
Yep.
And then it goes all the way back up. And so it's like the opposite. You kind of get on one side or the other of the trade, and all of a sudden you progress through life sort of always hitting the trend following in some capacity, or you're always contra trend and you're just getting wrecked over and over.
Yeah.
I've seen it happen both ways, and I just wish there was a way to put together the data.
I think it's a balance. There's going to be things that are balancing out, right? It's like when one industry is doing well, another industry is doing poorly, and then when it flips over. And so the job markets, you have a massive job layoff market over in this section over here with these jobs over here in this one community, and that impacts this community over here that's doing really well.
I think
right?
I think that's an idiosyncratic point, right? Like, hey, the economy's generally fine, but over here there's, layoffs in healthcare, and over here they're building a brand new, massive Tesla gigafactory, whatever, right? Like, okay. So on net, the
like if you were in
economy's fine.
software, like thinking in 2008, if you were in software, you were at the beginning. You were at the beginning, right? And auto manufacturers, real estate agents, lenders, banking institutions, that market, and everybody who was in those job categories, they were probably into this trend at some capacity, where software engineers and these other industries that were just starting to pick up and get moving, they're doing really well. And then they go in and scoop up all that real estate that fell down in 2011, right? So like depending on the industry, there's going to be, pluses and minus for each of those. So I think that's why a lot of times each individual housing market is so localized. Thinking of like, what are the jobs here in Washington County versus what was it in Detroit, right? What is it in Texas right now? What is it in California right now, right? Like these different industries and these jobs, like what drives the local economies derive that real estate market as well.
Yeah.
It's kind of fascinating.
Yeah. Real estate is always fascinating. I think we're running out of time, and everyone at this point is probably sleeping because they're so sick of hearing me and you talk about real estate.
I'm interested in this. I think it's interesting that I think it's
like
our market,
too, but
like our market specifically. I think this is a really interesting point, and it would be interesting to see other people's areas and different thoughts. Is like what makes up their economy. It's like 35, almost 40% of our local economy is completely reliant on growth.
Yeah,
construction, services, hospitality. All that stuff is, if we don't grow, 35% of our market shrinks up, right? And so when we face headwinds of growth and issues with growth, that's going to contract the economy, which is going to result in housing market in a different environment, as a delayed function of that. But those local economies are going to be one of the indicators as to whether your real estate's going to do well or not. I think there's a lot of correlation there.
Well, I think St. George is going to end up, or Washington County as a whole is going to end up being a great case study, post-mortem on the K-shaped economy.
Yeah.
And the asset owners, and the more well-off here in the county are doing really well. And the people that aren't are not doing well at all, right? It's a real struggle, right?
Yeah.
And if that growth contracts, those 35%, like the people involved in that 35% are going to be feeling the pain.
Yeah.
Quite significantly.
And it happened in 2008. They all left. They left the county and didn't come back. It's why our service industry was so poor for so long.
Well, our service industry still is
because they all
poor.
moved away.
Like our service industry still is poor, Rob.
That's true.
It's like the number one thing I get from people that come to town. Like they're like, like there's nowhere to eat. Well, it's like,
I don't have a good landscaper.
It's like, to start a restaurant here is incredibly tough because, no one wants to pay the price, right? And then no one wants to do the work.
And also
It's
food
tough.
cost distribution. We're not like a central distribution hub. So like the overhead, general cost
to get
on food
here,
is different than it is in other cities and other areas, right? So you're right. Labor is expensive because there's not as much there.
Yeah, everything here is expensive.
But I'm talking about even like landscapers and contractors.
I have said for the longest
service
time,
contractors, like simple
the way
things.
to be successful owning a business in St. George is to answer your phone, show up, do what you say what you do, and work hard.
Yeah.
Like you literally have to exist.
Yeah.
And you will be some version of successful.
And a big reason why we have that issue is that when the market crashed in 2008, all of those people that were doing those jobs had to leave the county because there was no other job, right? When the growth's not there, they went up to North Dakota, they went to the oil fields, they went to California, they went up north, they went back up to Salt Lake, and a lot of them just never came back. A lot of them just never came back.
Well, if you look at our local economy without the house, like really without housing growth, it's housing growth alone would destroy this county. Like when I say growth, I mean specifically new construction,
whether it's roads, developments,
Mhm.
earth movers, but it's HVAC contractors, it's plumbers, it's electricians, it's all these jobs that require new stuff coming in. You know, you think Orange County, they're already built out. So there's a big portion of that that's like, oh, maybe some redevelopment, but their economy isn't reliant on growth because they're already built out. All the land is already built, right? And so there's a smaller percentage of their economy that is dedicated to just growing, where we're in that phase where if we slow down growth, if there's water issues, or if there's some kind of moratorium on building or something like that, it would significantly impact the economic outlay. And it would hurt, like you said, the lowest tier on the socioeconomic ladder.
So talk about a headwind for real estate, right? Like residential real estate. So they have to keep building, right? If they keep building, that's more supply to the market.
Mhm.
Okay. That's a headwind for price appreciation in homes. Okay. If they stop building, it crashes the local economy. That is also a massive headwind for price appreciation, right?
Yeah.
So yeah, that's an interesting, quick framework to think about.
Yeah. And I think it's important for, city planners, local industry, whether it's networking, how do we get jobs here? How do we diversify the economy? Because it shouldn't be up to the politicians, right? It's not up to them to like encourage business growth and industry growth.
Right.
But I think it is something that we need to try to, how do we figure out as a community, how do we diversify that economy that it's not so reliant on growth that it's a do or die type situation. It's either we do it or we don't.
Yeah. I think we're getting into a local issues thing, which is like,
but I think
there was a different podcast for that.
Yeah, there used to be. Yeah. There was one at one point. But I think it's similar to other areas too, right? Because I think there's suburban cities, as the sprawl happens, right? If you go up to Salt Lake or you go outskirts of Texas, right? Home values went down significantly over the last.
The Dallas area has gotten. I don't know if it's fair to use the word annihilated, but
I mean, it's like the value, decrease has massively gone down because supply has gone up, but you're still, those new cities and those new towns and those new developments, they're going to face similar situations to where if they don't have the industry to drive those local economies, it is another headwind, right? And so I think it's an interesting idea to think locally, because you hear all the time, you turn on CNN and Fox and talk about the macro market or MSNBC or, the Wall Street Journal or whatever. They don't really talk about the local market and the local economic situation. And I think it would be helpful for people to pay attention to that a little bit more.
Yeah. Well, I think the macro economy is actually quite fine. Truthfully.
Yeah. I mean, I defer to you on that, so I have no idea. It's depending on what time of day I turn on what podcast, it could feel like doom or gloom or everything's great.
I think there's some things where you can, kind of, if you're at the party, you can kind of look around and go, this is probably going to turn out bad at some point.
Yeah. Yeah.
I think those guys over there are definitely going to end up getting in a fight kind of thing. But it's, I think in the more immediate future, it's not like things are rapidly deteriorating. Right.
Yeah.
And basically any economy has a level of productivity to it. Mm-hmm. And so if you're not in a recession, so if you're not contracting, you're growing, right? The natural state of the economy is growing. And I think that we're in that natural state. Again, I think there's, the economy isn't the market. The market's not the economy. The economy isn't necessarily housing. Housing isn't necessarily the economy, but there's some significant overlap. And there's going to be, some correlation. Timing is going to probably be different. Right. But the underlying health of the economy really seems to be fine for now. Right.
Yeah.
Again, I think, I referenced a K-shaped economy earlier. I think that's going to come to a head at some point significantly. What we're spending on AI data center build outs is going to come to a head at some point.
Yeah, when you talk about economy, it seems like that's where the biggest growth in the economy is from. Investments in those types of things.
Again, I'm not comfortable. Like, when we talk about, I think essentially at this point, the market really is going to lead the economy quite significantly in the sense that if the stock market stays high and asset prices stay high, the spending can continue to happen. Right.
Yeah.
And so as long as there is this perceived wealth because account balances are high via high asset prices, people are comfortable spending. If let's call them the central planners, continue to plan that the asset prices need to go higher, they'll probably go higher.
Yeah.
But I think SpaceX is an interesting example. I mean, that IPO'd on Friday. Total animal spirits out there. Everyone. I got more calls about the SpaceX thing, Rob. Like, hey, should I buy SpaceX? Right? This question. Hey, are we buying SpaceX? Hey, should I buy
should I short it?
Yeah. You're the one guy. Call me with that question. But like so many. I mean, like, man, I'm telling you, people that have never invested before are reaching out. People literally calling the office that have never talked to us before, saying like, I need your help getting SpaceX. Like, and it's like, okay, why do you think that? And they're like, because I can never get ahead in life.
Yeah, like
and this is my chance. I have some money and I need to put it in SpaceX, right? Like, and look, that's not what you want. Like, that's not healthy, right? But that doesn't mean it's the end. So I think like there's some underlying things that look, a large recession, and a significant, pullback of asset prices is inevitable. Okay. But not particularly imminent.
Yeah. Unless you're Ray Dalio, he thinks otherwise.
Well, Ray
we
Dalio,
don't have to go into the Ray thing, but.
Well, Ray Dalio is a macro investor, and what you find in macro is you're often early, and it takes so long for the macro to really come to fruition in price.
Yeah.
Right. In fact, that's what makes Stanley Druckenmiller so good at macro. So he's a macro guy, and he's probably considered the greatest of all time ever. He's average, I think, like roughly 30% a year his whole career, and never had a down year. Right. And he started with it, his kind of deal was like, you start with the macro, okay, because you're going to get half your trade right, just if you get the macro right. And then you just use technical analysis of timeless trades, but there's a lot you got to like keep an eye on, because you don't want to be too early. So you got to you got to know where the ship's heading. Yeah. And then you got to, get on the ship kind of at the right time. Mm-hmm. Otherwise you end up just like way too early to ideas. And so look, I have friends that worked at Bridgewater and worked with Ray. I think they're super intelligent people, far smarter than I am. But I guess what I'm saying is like Ray's, I think what he's wrong on is China, candidly. I think almost everything else that he says is really interesting to me. Mm-hmm. But just because something is perceived as being inevitable, like doesn't necessarily mean it's imminent, right? But to somebody that's been investing for decades and decades and decades, what seems imminent to him may seem like an investing lifetime away for a lot of people, right?
Yeah.
I mean, we live in a world of 30-second podcast reels. Sell my home in 3 days. I can find a new home on Zillow immediately.
Right.
Instant offers, blah, 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 all this stuff. So if you say something's going to happen in the next 18 months, by the time it gets to month 17, everyone forgets what you said.
Yeah.
Right. But in the macro world, that's like right around the corner.
Yeah.
So it's, interesting thing with Bridgewater.
Yeah.
Respectively, I mean, impressed. I have never engaged with or talked to somebody that spent time at Bridgewater that isn't incredibly smart.
Yeah. 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 When you're Ray Dalio, you have plenty of success and evidence to support whether you should listen to him or not. But I think to your point, it's the when, what's the horizon like? And things seem to always be not as bad as you think they're going to be, and not as good as you think they're going to be. You're thinking they're going to be better. You think it's going to be better than it actually is, and you think it's going to be worse than it actually is. And so where are we at in that middle, and where does that adjustment happen? But, to your everyday, investor, person listening to this podcast, it's take one step at a time. And especially if you're going to get into real estate, it should be a long game. Should be thoughtful about what you're going to do, and all the stuff you find about getting, rich in real estate and investing your way into financial freedom through real estate. All that stuff's old. It's too old. none of the environment of those videos. If you look at the videos of like, hey, this is how you get rich in real estate, they're probably all 3 years old or older, because that is not the economic environment. That is not the housing market.
I think the way you get rich in real estate right now is to just probably rent a place and invest money somewhere else. Candidly, that's my.
Yeah, no, I think I don't think you're wrong. I don't think you're wrong. I think it goes back to what is it the lifestyle that you're actually wanting? Are you buying real estate as an investment, or are you buying real estate to live in a community and have a quality of life that's what you envision your life to be?
Yeah, there is a. Let me add one last thing as we wrap it up here. There's a guy, and I'm trying to remember his name off the top of my head. His X handle is Strip Mall Guy.
Oh yeah. Well, I follow that guy. Yeah, I followed him before. Yeah.
Yeah. He's a commercial. Well, I mean, specializes in strip mall properties.
At one point he was. Anyway. I don't know.
I think that's all he does. Yeah, all he does is strip malls. That's definitely his niche. I'm just trying to remember what his name is. He lives in New York City, and he does stuff primarily, really across the country.
Yeah.
Buys and operates. He's not like a salesman. He's not a broker, right? But he says something like along the lines of like, look, everyone else buys real estate because they think it's going to go up.
Don Tetman.
Yeah.
Don Tetman.
So Don says, everyone else buys real estate because they think it's going to go up. He says, I buy real estate that I know I can make go up. Right. So it's a market, in my opinion, that look for those opportunities where you have edge. Right. So if you're a developer and you know what you can get passing zoning changes and build it out and make you can make the values go up, right? If you're somebody that's an experienced real estate investor and you can buy a property and do a certain kind of rehab and raise rents and it fits your rental pool the right way and these sort of things, like, man, that's awesome, right? Like you have edge. If you're like, hey, I got a $50,000 bonus or a small inheritance and I think I should just go buy one single family rental and I'm going to own a rental, right? Or, hey, I'm going to, I do feel comfortable getting a little bit bigger house now. And so I'm going to move up. Like, should I, everyone tells me to keep my home and keep it as a rental and, get the next one. Like maybe not. Right.
Yeah.
So you just like figure out where you've got edge, extract your edge. But I think like, from the what we'd call the beta side of real estate, which is just like, hey, you can just own any real estate in the real estate market. It's kind of going to give you the return. I think it's a very underwhelming environment to be too excited about.
Yeah. It's a good way to wrap it up.
So
thanks for having me on, man.
Dude, thanks for coming back. It's good to see you again.
Find me on realestate435.com.
Still doing it?
Here in Washington County.
Yeah.
I haven't been doing the podcast. Yeah, man, it's a heavy lift to do a good job.
It is a heavy lift to do a podcast.
Yeah. To do a good job, right? I don't want to, the last thing I want to do is just hear myself talk and just to say I have a podcast. So if I'm going to do a good job, I got to make sure I have the resources, time, energy, interest, passion for it. And we did it for 3 years every single week, and it's a lot, dude. So
I know
you're on the train still.
Still going strong for now.
That's right.
Okay.
All right, man.
Where do they find you?
realestate435.com. Yep.
Okay.
Rob the Realtor, 435, Instagram.
All righty. Any other questions, comments, jokes, concerns, hate mail? Hit us in the comments. Let us know. Always love hearing from everyone.
Send it to Jeff at realestate435.
Just the hate mail.
Just the hate mail to Jeff at realestate435.com.
All right. We'll see you guys all out there.
See you guys.